This is Taking Stock on Bloomberg. I'm Julie Hyman in for Pim Fox. Well, Texas Instruments, the latest company to lay out a disappointing vision for the near future, giving an updated second quarter sales and profit forecast this afternoon that falls short of analyst estimates, not to mention Texas Instruments' former forecast. Here to talk about what they see ahead for the market and the economy is Jay Pelosky. He consults on global asset allocation and strategy for J2Z Advisory. Also with us, McAlinden. He's chairman and CIO of Catalpa Capital and the former chief investment officer at Morgan Stanley Investment Management. Gentlemen, thank you so much for coming in. I do appreciate it. So let's talk about Texas Instruments if we can, because a lot of investors have said, well, even if the economy's wavering, corporate profits have been fantastic. And yet increasingly we're seeing companies come out with not so fantastic outlooks. Jay, let's start with you. Do you think this is just what we're going to continue to see more of for the coming months?
I think you will see a little bit more of this as we move through the second quarter, because a lot of companies are affected by this slowdown that we've seen in the macro data. You don't have a slowdown in the macro data without it showing up in some companies' reports. The question is, how sustained is this slowdown going to be, and what's it all about? And I have a point of view on that, which I'd be happy to share with you.
Go for it.
Well, there's a lot of things out there that people are pointing to. Some of them are more systemic and longer lasting. Others are short-lived. And I think that it's the short-lived that's really driving this, primarily the tragic earthquake in Japan and the effect on the supply chains all over the world, which has affected a wide range of companies, a wide range of sectors of most economies in the world. But this will pass, and by the third and fourth quarters, we're going to be back on a strong growth track.
What do you think, Joe? Is this short-lived?
Well, I wish I could agree with my old colleague, but I don't. I think, unfortunately, we're in for a rough, probably 12 to 18 months, mostly because the governments here, but also in Europe and in China, are pulling back from fiscal and monetary support. And those are the two things, if you think back to what's happened in the last 6 months in terms of stocks, that's what's really propelled stocks. QE2 at the end of last summer, beginning of the fall, then the Obama tax cut deal. Those were the things that propelled stocks. Going forward, we're not going to have either of those things. And so to me, I think the market is starting to realize that there really are no more rabbits in the hat, and that we are on our own. And the earnings picture is key. If that starts to really suffer, then I think stocks have fairly significant downside.
I'm sorry, Joe. What about the jobs part of this equation as well? I mean, doesn't that give you pause that this is going to be a little more long-lasting? Because the sort of not a blockbuster job growth, can we say at the least, that pre-existed the situation in Japan.
Yes, it did. But the job situation is very bifurcated. You kind of have two categories: the people that have been laid off for a long time and people that are in kind of the baby boomer demographic. They are both going to have a hard time getting jobs in this economic environment. And the unemployment rate in both of those cohorts is going to remain very high, in my opinion. However, in other areas, younger folks, people that were laid off more recently, they're getting jobs back fairly quickly. And there are shortages showing up in some industries. And you're beginning to see some upward pressure, actually, on average hourly wages. So I think that, sadly, for politicians who are going to be running for office in 2012, the overall unemployment rate is going to remain fairly elevated, somewhere, I think, by next year in the 8 to 9% range. But the employment situation is going to be slowly improving as we bounce back from this earthquake-induced slowdown.
You know, I'm curious how each of you are sort of playing your scenarios in terms of investments. Jay, you're more cautious. Are you looking more at defensive sectors in the stock market?
Well, I've actually raised some significant cash over the last month or so. I'm at 10% cash in my own personal portfolio, which is about as high as I've been in the last year or so, hoping for an opportunity to buy. And I think that's really the question for the investors coming forward. We're going to go back to the lows of March. 1250 on the S&P. We're at 1285 today. That's not a big deal. That's 2% away. I think the question for investors is, do we buy that? And on the fixed income side, the question is, do you sell Treasury bonds that have rallied from 380 in February all the way down to 295 on the 10-year today? I think you're going to go further. I've been long Treasuries, been bullish on Treasuries. And so the question really is setting up, do you buy at 1250 on the S&P and sell the 10-year bond at 275 or so, or do you wait? And my answer is, at this point, I am probably not going to be a buyer, because I think there's more downside risk. And the real key to me is what happens in emerging markets. If they slow significantly, the earnings in the U.S. are going to fall off a cliff, and that's what's going to take us down, potentially down towards the 1100, 1050 level, where we were at only a year ago.
And Joe, are you looking, on the flip side, are you looking at some of the more cyclical sectors that may start to pick up?
We look at a lot of the same data, and 1255 on the S&P, 1250, 1255 is exactly a key Fibonacci point, as well as its 3 standard deviations off the 60-day moving average on the market.
You're looking
it's
at the charts, in other words.
I look at everything, and it's a very probable point at where buying comes in. If it breaks through there, it's going to go probably a lot lower. We will be buyers at that level because we believe this is a transient thing. As far as the cyclicals are concerned, we think that at probably around the same time, you're going to see a turning point in commodities, and you're going to get another strong run over the course of the summer in commodities, particularly the softs. But yes, I think the cyclicals, and believe it or not, I think that sometime in the next several months, the financials are going to bottom out, and they're going to have an unbelievable rally in the second half of the year.
Don't we need Dodd-Frank to be a little more resolved before that happens?
The pundits have raised a lot of issues to explain why the financials have acted so poorly. A lot of it's the fundamentals. Trading volumes are down, M&A fees are getting squeezed, and these guys are hurting. And Dodd-Frank's out there also. I think it's mainly going to be a steepening of the yield curve, which improves their business climate, and a pickup in volumes that are going to make the investment banks have a big rally.
All right, guys, unfortunately, we're out of time. Joe McAlinden and Jay also joining us. Thank you so much, guys, for giving us a little bit of a debate here, which is always nice to have. Appreciate it.